All right, all right. It's good to see everybody here. Glad to have you. I'm glad everybody could make it. My name is Lan Turner, and this is our lab class for the class that we had last night down at the university. So we did an introduction to dividends. What are dividends? And dividends, of course, are where stocks pay you a little bit of a share of what they make. All right. Usually it's not very much, but oftentimes it can be a substantial amount. And so we want to talk about how we can capitalize on and take advantage of dividends in our trading. Now, one of the things that you're going to find that when you do dividend trading with individual stocks, that it's actually the growth side is actually more important than the dividend side. So I like to break those two in half. So we have to look at them from two separate points of view. We have to look at the growth side, and then we look at the dividend side, or what we call the yield side. All right. So we have growth and we have yield. And so what we want to do is we want to have a nice high growth stock that also pays yield. If we have a low growth stock, the yield oftentimes when trading stocks, they're so small that they don't pay for the loss on the stock. So the problem with dividend trading, traditional dividend trading, and the reason we're having this class is because we're going to move into high yield stocks and ETFs. And right now, this is kind of the traditional method. This is the way we've been doing it for, umpteen years, 30, 40, 50, 100 years. We've been doing dividend trading with dividends on stocks. And a traditional dividend, that's what a dividend is. It's a little tiny share of the profits that they give to you along the way. So what they're doing is they're taking some of the profits out and they're giving them to you out of the share price. Okay. So that you get to take and go spend. Oftentimes the problem is, as we talked about in class last night, those dividends are so tiny that you have to have such a huge amount of money. Sometimes we talk about like maybe $2 million, right? That's the number that you always see thrown around. $2 million to have maybe a $50,000 dividend that you can live off of. And then, we also talked about the 4% rule where you can take 4% out and still have your growth stocks go to the point where you don't run out of money. One of the biggest fears that people have when they trade, well, it's running out of money, right? People don't want to run out of money. And so we have to find or devise these different ways of making money. And so that the money is coming in as we get older and older, and we don't want to die before we run out of money. So dividends are one of those things that people turn to, and they're like, okay, well, dividends are kind of a neat thing. It's money that's coming in, and I don't have to sell my shares. And that's the biggest thing about dividends. That's the one key point here, is that we don't want to have to sell our shares, because then we no longer get the dividends, right? So if you have if you have shares and you're just living off the dividends, if you sell your shares, you lose your dividends. And so that's kind of the conundrum that we run into. And we're going to talk about that in greater detail as we start going through some of these upcoming classes, as we start going through ETFs that pay dividends. And then we're going to go into some other high yield dividends. We're going to talk about different ways that we can capitalize on this market. And it starts to become a brain shift. And the stock market is kind of an amazing place. All right. We can do just about anything in the stock market. We can reproduce in the stock market just about anything that we can do out in the real world. So if you want to buy low, sell high, that's like a store, right? We talked about that in recent classes. You want to go buy a bunch of toys from China, right? Import them, put them in your store. Well, you'd buy them for $10 and sell them for $20. That's buy low, sell high. That's the model that is most prevalent, and that's what most people do when they think about the stock market. Most people, and I've taught this class, I've taught the dividend class for years and years and years. Now, we've only been able to add on this new feature to the dividend class within the last couple of years just because it's brand new. It's something that the financial markets have changed some of the rules and allow us to do, and that's what the next class is going to be about. So we want to learn this class. I'll give you a little bit of a foresight into what's coming, but this class is kind of the traditional method of trading dividends, and it has to be combined with growth, and that's what everybody understands in the stock markets. Buy low, sell high. We're going to buy a used car and go put it on a used car lot, and we're going to sell it for more than we bought it for, right? That's how things are done in this world. We buy low, sell high. So when you come into the stock market, that's what most people's brains are all tied into. They don't really understand that you can do different models of trading and investing in the stock market. So they're all stuck on this buy low, sell high model, and they can't get that out of their psyche. And so I tell people the very first time you walk in the class, I'm like, okay, this class is meant to change your mind. I'm going to have to rotate you into a different form of thinking to be able to trade like this. This is all growth first trading. We're going to get to the point where we're going to do yield first trading. And we're going to trade places with those where the yield becomes more important than the growth. All right. But when we're doing traditional dividends, the growth is more important than the yield. And you have to break those two apart and realize that they're two income sources. All right. I get money from this income and I get money from this income source. So we have two income sources. One is growth, which in the traditional sense of things, that's the big income. That's where we make all our money. And then the dividend, well, that's a little plaything that you might want to, if I get in some dividends, maybe I'll go take my wife out to dinner. And that's how big they are, right? They're tiny in comparison. Now, if you have $2 million in there, well, that little toy, little play money that they give you might end up being big enough that you can go ahead and use it for living expenses when you retire. But a lot of people don't. It's very difficult, even working as hard as you can your whole life, to save $2 million just so you can have $50,000 in dividends. So we need to do some different things. All right. We need to do some different things. Now, I mentioned last night in class that sometimes what happens is you end up with having to take on more risk, right? So you pay for security. So if you take your money and you go put it down at Cash Valley Bank in a bank CD, you're going to get a very small return, but the money is very safe. All right. You're not going to lose it. They're going to give, if you put $100,000 in your bank account down there in a bank CD, well, in 3 years, they're going to give you $300 or something, and you're going to get your $100,000 back. They're not going to, your $100,000 isn't at risk. You're not going to lose it. The bank is the one who's taking the risk. All right. They're going to take your $100,000. They're going to lend it out to somebody else, or maybe if they're an investment banking firm that you put your money in, they're going to go put it in the stock market, right? Or they're going to go do something with it to make more money. They're going to make 10%, 15%, 20%, whatever they can charge for, right? To rent that money out to somebody else. And then they're going to give you that little 2.5%, 3%. And then they keep the rest. That's their profit. That's how they make money. They take your money and invest it in something that's riskier than what you're willing to risk it in. And then they get to keep the difference. So that's how they make money. Well, I'm too risk averse. I don't want to risk my money, so I'll let them do it. They can make their money. I don't care. I'm risk averse with this money. Now, it doesn't mean that you shouldn't do that. Another problem that a lot of people get into is they think that, oh, land taught me this, oh, land taught me that, and so this is what I'm going to do with all my money. No, you don't have to do all your money in any one thing. I have bank CDs, some money sitting down there in Cash Valley Bank. Actually, mine's in Bank of Utah. All right. I have some money sitting in Bank of Utah in a CD. Of course I do. Right. That's safe money. I've got money. I collect money because I have real estate. I have HOA money. Right. I can't risk that money. It's not mine. I mean, it's mine, but it's not really mine. Right. It's got to be there to use for the HOA. And so that money goes into a bank CD and it's very safe and very secure. I'm not going to have to go to the people who gave me the money for the HOA and say, well, I invested it into Google and Amazon and Netflix, and Netflix went to the floor and we lost all our money in the HOA. They're not going to be very happy with me if I do that, right? So there are different reasons why you would put money in different places for different purposes. And we don't just go and do all of our money into one thing. We break it up in different places. So some of my money is in a bank CD. I have managed money. I have professionally managed money because I don't want to risk all my money in my own personal little high portfolio. I have some managed money. So I take some of my money and I put it over here. If I make a whole bunch of money over here in this higher risk area, I'll take it out and put it into the lower risk area. I won't make as much money, but it's safer because we're going to pay for security, right? We're going to pay for safety. And the way we pay for safety is by having smaller returns. And so I have lots of accounts that I have money in. This account is taken care of by these people. They do it for me. This account is for the HOA. That's in a bank CD. This account is over here. This is where I do day trading, which is really highly, suspicious. That's a little bit more difficult. So that's a CD, an account that I have. I have my IRAs, my 401ks. Some of those are self-directed. Some of those are not. And then I have my big UBI account, Universal Basic Income account. And that's the one that's pretty aggressive, and I trade as aggressively as I can. I actually have an account that I trade options on where I do options, and that's pretty aggressive. So I have lots of accounts. Now, I like to break accounts up and do different strategies in different ones. Now, remember, we talked about this in the beginner class, or in the class last week, where we said, what type of trader are you? And oftentimes traders will come in, and what they'll do is they'll start and say, well, I'm going to be a day trader. And they'll start day trading their money, and then they get into a bad position, start losing, and then they don't want to sell it because they're like, oh, I'm just going to wait for it to come back. They don't get out when they're wrong, right? They don't admit that they're wrong. They don't get out. And so then they say, well, I'm not going to be a day trader with this one. I'm going to just be I'm going to be a buy and hold bag holder with this one. I'm going to hold on to it until it comes back. I may end up holding on to it for months. And, it started out as a day trade. I was just going to get in, get out, get in, get out, get in, get out, do my little day trades. But because my trade went against me, now I'm going to hold on to it for 6 months, waiting for it to come back. Well, that's where that saying comes in, that markets can stay irrational longer than you can stay liquid. Okay. That market can go down forever, and you can be stuck in that account forever and just lose. And it might take 6 years for the money to come back, right? May never come back. Who knows, right? Depends. So we have different strategies for different buckets of money. So what are we going to do with this bucket of money? What are we going to do with this bucket of money? What are we going to do with this bucket of money? Now, most of us who are in this class have done nothing, right? We don't have any investments in the stock market. Now, we started this new class, and I know that there are a few, we raised our hands, and a few of you have a little bit of experience in the stock market. So we got some people who have a lot of experience. I talked to a couple guys last night who've been trading for a very long time, and they've got a lot of experience. In fact, a couple of those guys could probably teach these classes. So we've got a various degree of people in this class. We got guys who have lots of experience, and we have people who have almost zero experience, or who have zero experience. So for those of you guys who have lots of experience, well, you're going to be doing a lot of review, because stuff you already know. And that's okay. There's nothing wrong with having a review in class, but maybe you'll pick up a few things along the way. And especially when we get into the next class, where we go into high yield ETFs. We're going to do ETFs tomorrow, because ETFs, they also pay out a dividend. And then next week, we're going to take a week off. And then the next week, we're going to have the following week after that, we're going to have high dividend ETFs, and we're going to learn a whole new strategy. So it's going to be another bucket of money. All right. So we're going to put buckets of money in different locations, and we're going to trade different ways. So the money that we're learning about today is we're just getting an introduction to dividends. What are they? They're money that a company gives you to help you feel like you're doing well. That's really what it is. All right, we're going to go look at some of these, some of the more popular ones. We're going to look at some of the popular stocks and see what dividends they get. I'm going to show you how to calculate dividend profits. We're going to then build some portfolios. All right. Now, I've done a lot of the pre-work for us, so we're not going to sit here and do the discovery. I've already done the discovery for us. I'm going to give you the list of stocks. I gave you a list last night of the ones that were very popular in the S&P 500. I've got another couple of lists here that I think are fun for you to look at. And then we're going to go build portfolios, and we're going to see what those portfolios would have done in the past. We can actually calculate and see what the history was on those portfolios. All right, so we're going to look at individual stocks, see what the history is. We got really cool little calculators that kind of do that for us and show us the difference between the yield and the growth. Now, remember, we've always got yield and growth. We always want to take into consideration yield and growth. So the first thing we're going to be looking at here is the top 10 dividends from the S&P 500. And you can see I've got that listed here. I'm going to pull it up and show you where I got the list from. It's very easy. We've now got, we used to have to do a lot of research, and you used to have to go buy these lists. You'd go and buy them, or from different brokerage firms, and they would give you a list, and they say, these are the top 10 or top 5, or you could go out to a scanner and you'd have to scan and you have to work on it. Now you got ChatGPT, or you've got, here I'm using Google Gemini. I have all of them. So I just pick the one that was closest to my mouse clicker at the time. This one's from Google, is Gemini. And I just went into Gemini, and I like Gemini. It's a good one. ChatGPT is fine. If you got that one, use that one. Grok's great. I love Grok. Grok's came up with a little notice and said he's having some problems today, has a little bit of the flu. So he's having some server problems. And so we're going to be using Gemini today. And so in Gemini, I just went in and I said, I want to know the top 10 dividends. I just gave it a little thing. Can you research for me the top 10 dividend aristocrats, please? Now, and that's the aristocrat list. And up here, I said, can you research the top 10 dividend paying stocks in the S&P 500? So that's the list we had last night. If you remember, it was the last slide. Some of you have that. You took pictures of it. And then, of course, I sent you the slides. You should have received an email from me that had the slides. If you did not receive an email from me, check with me when we have class tomorrow night and see if I've got your correct email address. All right. So I sent that email out already. You should have that. And it had a link to this class. And of course, we also had the link to the slides. So you should have that. All right. So this is our top list out of the top list of the highest dividends out of the S&P 500. So we're going to go, and in the interest of time, I've already typed these into our trading platform. And for those of you who are not aware of the trading platform that I use, now, if you want my help, and that's why I'm here, that's why you signed up at Utah Tech University, is because you want Land Turner's help. I use this trading platform. If you use a different trading platform, that's perfectly fine, but I'm not going to be able to help you very much with it, all right? So if you haven't got a trading platform, or if you would like to switch to the trading platform I use, then this is the trading platform I use. So you can go get it, and then you can have it ready for you when we get together and we trade together. All right, here you go.
Okay, this is the software I use. It's called Track and Trade. They've got two versions, one for stocks, one for futures. This is the website, track, the letter N, trade.com. This is where you download a free 2-week trial. No credit card required. Okay, go download your copy, then come back here, follow along, and I'll show you all my settings.
All right, so that is the trading platform that I use, and it is like the Ferrari of trading. All right, it's for retail traders. So if you want the Ferrari, you go get that platform. We're also going to show you a free platform, or it's not a platform, it's just a free charts. I'm going to show you some free charts too. And there's advantages and disadvantages to each, and some do some things and others do other things. I've got 3 software programs I'm going to show you here, but my primary trading platform is Track and Trade, and I would suggest that if you don't have a trading platform, of course, that's the Ferrari of trading. It does cost money. It's not free. There's a subscription service that goes along with it, and so just make sure that when you go to get it, if you want to buy it, go get the free version, download it. I'll show you all my settings. If you want to end up subscribing to it and buying it, make sure you call them on the telephone. Tell them that you're with the St. George University class, Land Turner's class. They give you a discount. All right. So for those of you who are not with the university class, you can just get it off the internet at that price. I would call them on the phone anyway. For you, I know we get a lot of people in the YouTube class who are not from St. George. We got guys coming in from all over the world that join us, and that's great. And we love you guys too. The software company does give a break to the guys who are from the university, so you can call them. But you know what I would do if I was from Bangladesh and you were here and you wanted to get a copy of the software, or you're from Texas or Oklahoma or wherever you happen to be, call them on the phone and say, hey, I heard you guys give a discount. Can I get that discount? They'll probably give it to you anyway. All right. But they do give it. It's specifically set aside for the St. George people, but it never hurts to ask. That's all I'm saying. Call them on the phone. All right. Track and Trade. All right. All right. So here we go. This is the first list that we're going to go look at. This is the top 10 stocks for dividend yield. And you can see right here, Lendell LYB Materials gives you an 11.2%. Congra Brands CAG Consumer Staples gives you 8.3%. Alteria gives you 7. I'm just going to Health Peak 7.3. Heinz 6.8. Verizon 6.8. Pfizer 6.8. Vicky 6.5, United Parcel, UPS 6.1, Amcor 6.0. So now what we're going to do is we're going to take this list and we're going to go over into, and I've already typed them all in. You don't have to type them. You can ask Grok. I'll show you a neat little trick in here. We're going to come in here and I'm going to ask Grok. I'm going to say, Grok, this isn't Grok, this is Gemini. Can you parse? How do you spell parse? Parse. Can you parse for me it says that's not right. Parse for me the top 10 dividend list into a comma separated CSV file, just like that. And what it's going to do is it's going to take that list and it'll put them in comma separated. Clarifying the request. You spelled dividend, or you spelled separated wrong. Separated. And so it's going to go through and it'll put those into it. It's taking its own sweet time here. So see that it's putting it into a little CSV file for me. That's kind of a weird CSV file. That's not what I was looking for. I wanted just the ticker symbols. All right, Grok's a little better at doing this than Gemini. Just the ticker symbols. All right. Just to show you that you can do it. Come on, you silly dog. Okay, there they are. So now what we can do is we can take this. Oh, look, see, it's done all of them for us. So we can just grab this, the top 10, and you can grab those like that, and you can highlight them, and you hit Control-C, copy, and you can come over to your software platform, and I'm going to just say new. This is just a test portfolio. Say okay. And I'll show you, you can just take that, put it in the list, and hit V, and it puts them all in there, and now you can just open them like that, and you don't have to type all the symbols. So again, you can use your AI system, whether it's Grok or ChatGPT or whoever, and they'll put them into a comma-separated list, and you can just type and paste them right into that list. Now, I've already typed them in there. I've already got that done. So we're going to come in and we're going to look at you can see I've got them in here. These are all my portfolios of all the different things. And so we're going to say this is the top 10 stocks here's the S&P top 10 dividends. So that's that one. So this is one we just looked at. And we're going to go down through the list. All right, so let's pull that list back up again because I want to look at how much. Well, I'm going to show you how to find out. We don't have to go look at this. This is what Gemini said. Said 11.2, 8.3. Let's go look at some of these. I'm going to take this off to the side, put it over here on my other screen. And then we're going to come over and I'm going to show you another little program. All right, a little cool little program that you can pull up. And we're going to come into, this is called FinViz, all right, FinViz. And this is a free charting program. So if you don't have track and trade, you don't have a trading platform, and you want to start looking at stocks, this is a good one. It's just a little, you can't trade with it. You can't do anything with it. You just look at charts, but it's because it's free, it's got lots of pop-ups. Now I pay for it. I subscribe to it because it's got a few features in there that I want that nothing else has. And so I pay for it so I can get these 2 or 3 little features that are not free. And that's these lists down here. So this stuff here is not part of the free group, but if you pay for it, you don't get all the ads, which is annoying anyway, right? And then I get these little charts down here. So if you don't want to pay for it and you're okay with seeing ads and you want to see these little charts down here, just let me know and I'll show it to you. Say in the class, say, hey, pull up, XYZ chart. I'll pull it up and I'll show you these little charts. You can take a picture of it and look at it for your own study, or you can just go ahead and buy it and then you can have this stuff. All right, but there's things that we want to look at when we look at these charts. So the first thing is that it says that LY, this one's VST. So VST, oh, that one's not in that list. How did we get? Oh, this is the one that was already here, right? So we're going to put in the ticker symbol. We're going to put in here LYB because that was on our list. Spell LYB. Okay, LYB. So this is our list right here. Come on. So that's our list. We're going to look at LYB. It says it's approximately 11.2% on the dividends. So we're going to come in here, and there's LYB. And look at what the stock's been doing. It's going straight down. Buy low, sell high, right? But do we want to buy into this stock? It gets a high dividend. Now, we can see the dividends. Now, remember, the way we calculate dividends are given to us by the number of shares we own. So that's what's really cool about dividends. The more shares you own, the more dividends you get. So they're based on the number of shares. Now, you look at the shares. The share price over here is $50. And then we look at this little dot right here. If you touch on that little dot, it tells you it's going to give you $1.37 for every share you have. Now, the shares have been going down, so the share price is less. If you paid $75 for your shares, clear back here, and today the shares are at $50, well, you still get $1.37, but you paid $75 for them. So your return is going to be less than the current return. Does that make sense? Because you paid $75 for your shares, and you're going to get $1.37 per share. But shares are trading for $50 today, and you're going to get $1.37 per share. Okay, we all on the same page with that? So let's come in here. Let's do a little math. This is a math class. Remember that trading is it's just a math class. So we're going to take our little calculator, and we're going to come in with our little calculator, just like, on your little phone. And this is what you're going to do. Grab your phone and do the math with me. All right. We're going to take $10,000. That sounds like a good round number, right? We're going to take $10,000. We're going to use that as our benchmark. $10,000, and we're going to divide it by the number, how much a share cost? $50. So this is $50.60. We'll just say $50 divided by $50.63. Okay, just like that. Just like that. 10,000 divided by $50.63 equals, that means we're going to have 197 shares. Very simple, right? 197 shares. So if we have 197 shares, we're going to get $1.37 per share every 3 months, every quarter. So we're going to come in here and we're going to go times 1.37 equals $270. That's pretty cool, right? $270. So now you back into that and you say, well, how much money would I need to live off of a LYB, right? How much money would I need to live off of LYB? So you say, well, if I put $10,000 in there and I get $270 every 3 months, let's go ahead and divide that by 3. Divide by 3. That means you get $90 a month. Well, I can't live off $90 a month. Okay, well, what do you need? Well, I need an extra $5,000 a month, or I need an extra $1,000 a month. You could just back into it and say, well, if I need that much, I could multiply it out and I can figure out how much money I need per month, and I would know how many LYBs I would need to make the money I need to live, right? Very simple stuff. That's what we do with dividends. That's how we trade dividends. So we back into it. We're always backing into it mathematically. And then what we can do is we now have to look at the loss of money too, though. Because if we bought it back here when it was $75 and the market is now trading down here at $50, we have to take that loss into consideration. And did the dividends pay for the loss? Or do we not care about the loss? Maybe we don't care about the loss. We're just living off the dividends, and it's going to give you the dividends. $1.37 here. How much was it back here? $1.37. How much was it back here? $1.37. See, so they're very consistent when they give their dividends. They don't change them very often, but sometimes they do. They'll change them sometimes once a year. And so we have a list of that too. It's called the dividend aristocrats. All right. Dividend aristocrats. So this is just the top 10 S&P stocks. All right. And then we come down to this next list. These are the top 10 dividend aristocrats. Now, what does aristocrat mean? That means that they raise their dividends every single year for 25 years. For 25 years, they've raised their dividends every single year. Now, if you look at what their approximate yield is, look at this one. This has had 56 years. So some of these, can you research the top dividend aristocrats? And the aristocrats are ranked in their approximate dividend yield. So they come in here, and the aristocrats, again, for the last 25 years have raised their dividends. But look at some of these. This is J.M. Smuckers at 4.1%, and they've raised their dividends years of growth. It says right here, 27 plus years. How long did it take them to get to 4%? 27. Remember when I drew that little picture on the board last night of a drip? They're drips. That's small. It took them 27 years to give you 4% return. That's about what you get down at Cache Valley Bank in a CD. Well, maybe it's a little higher than Cache Valley Bank. Let's go pull up some of these, all right? So hopefully you're taking pictures or you're doing the research yourself with your own. You're asking these same questions. Can you research for me the top 10 dividend aristocrats, please? So that's what you would ask your Grok system. And then it's going to give you this list. This is the list it gave me. And so it came in here, it says years of growth. So 25 years is the minimum. And then it came down here and it says, well, I can do kings too. All right, well, do the kings. The kings are let's see, that's 25 years. And then this one here is 50 years. So it broke them out into 2 lists. So look at this, they've raised their dividends for the last 50 years. That's pretty crazy, right? So here's our 25-year list right here. Hopefully you guys are taking pictures. You can grab your little phone and you can take a picture of this if you want to keep these lists. So I'll leave it there for just a second for you to take a picture. All right. And here's the next one. This is the one they've raised their dividends over the last 50 years. Now look, Altera, MO, up to 6.6% after raising them over 50 years. Finally got up to about 6%. Okay, so you got a picture of that one? So now we're going to go through. Now I've already put these into our trading portfolio. So there's the top 10 dividends. We're going to come in here, and here's the aristocrats right here, the 25. So let's go to 25, and we're going to look down through some of these, all right? Now look at this one. This is MO, and we're going to go over, look at that one. It's taking off like a rocket ship. So that's a good one. Altera. So let's go over and look and see what this little tool here. We're going to pull up MO. And it's taken off like a rocket ship. And you can see right here, it paid its dividend, $1.06. Now its shares are $63, very similar, close to what the last one was, with $1.06, a little less on the dividends. So you're going to get a little less than $90 a month from that, right? Or is it $90 a quarter? I can't remember. It was $90. I think we did the division. It was $90. Yeah, because we divided it by, we did it divided by 3. 270. Well, that was the last one. Let's do it again. We'll do one more, and then we'll go and have the calculator start doing it for us. All right, so we're going to take $10,000. We're going to put $10,000 in. We're going to divide it by $63, and that gives us $158 or 158 shares. And then we go times 1.06 equals, it's $168, and they pay out quarterly. See that? These little blue dots down here tell you that it's quarterly, every 3 months. So every 3 months, you're going to get $1.06 for every share you have. And that comes out to be $168 with $10,000, $168. Now, again, it comes back to the problem is that the market moved today. $10,000 probably moved more than $168. So in one day's movement, you just shot the entire quarter's dividends. But that's what happens. That's why we have growth and we have yield, and you have to keep them separate. Okay. So we have another list. Let's go over and look at the kings. All right. Let's go over and look at the kings. That was the aristocrats. So now we're going to come down and we're going to do the kings. So if we come back over to track and trade and we pull up the kings, you can't build a portfolio over in the little free one. You have to have programming. You can have a portfolio. So here's your kings. So here they are. So we got Black Hills Corporation. Look at that baby going to the moon. Should have bought it back here, right? All right. So now as you kind of rotate down through these, you can see there's the Canadian Utilities. There's Federal Realty. There's Fortress Inc. There's Kimberly-Clark. Whew, that's a nasty fall from grace, isn't it? There's Altera. That's the one we just looked at. There's NFG, SWK. There's Target, UVV. Okay, now I'm using a special piece of software. Again, I got a special tool in here in Track and Trade. It's called the Bulls and Bears. So if you pick up the Bulls and Bears, you can get this tool too. It's a plug-in. You have to pay extra for it. Actually, when you do the subscription service, it's included. It's included in the subscription service. Now we go into much greater detail. We talked a little bit about this in the last class. So for those of you who missed the first class, we did talk about this particular tool just a little bit, and we'll talk about it in greater detail when we do the class in March. All right, we're going to go into great detail about the technical analysis, and as I mentioned last night in class, all the formulas that we use to help us determine when it's the best time to buy into stocks and how they're manipulated in some degree by these big banks and hedge funds and how they trade. Because we want to know how they trade, because we want to kind of trade how they trade, or at least we want to know what they're doing so that we can be smart enough and wise enough and look at a market and say, oh, that's what they're doing. These indicators are telling me that's what the big banks and hedge funds are doing right now. So we want to know that and understand that so that we don't get caught in their bear trap, right? All right, so you can see down in here, going from red to yellow, that's kind of a little signal right in here. The market's getting ready to go. There's another little red to yellow. That's another little signal. Here's a red to yellow, and it finally went to green right there. So it took off a little bit. Now we're getting another one right here, yellow to green right here. It's getting ready to take off and go to the moon, right? So this might be UVV, might be a good one to get into. Start doing a little accumulation, get a little shares in here because it's a high dividend paying stock. It's going to also give you that nice little dividend, that little icing on the cake. And you're also going to have a growth stock. So we want to be looking at growth and yield, and we want to look at those independently. So now now that we've got our three, I want to do one more for you. So we've got our three portfolios here. We got the top dividends in the 500. We can look at those stocks, right? We've also got the aristocrats, which have been raising their dividends over the last 25 years. And then we've also got the kings. The kings are the ones that have been raising their dividends over the last 50 years. Okay. And now we got the most popular stocks. So I've got that list too. So these are the most popular stocks that trade dividends. So here's another list. Go ahead, take a picture of that. I don't have that one in Grok. This one's one that I have in my own portfolio. So go ahead and take your little camera and take a picture of that screen right there, because that's the most popular stocks that have dividends. Now, for those of you who follow Warren Buffett, you know that he holds Coca-Cola. Coca-Cola gives him a lot of dividends because he's got a lot of money in there. Okay, so that's one he likes. So if you come in here and look at this market, you can see it's starting to take off, breaking new highs right in here, $73. So let's go over, and just for fun, let's look at what Coca-Cola's dividends are. So we're going to go in, it's KO. All right, so there's KO. And you can see its dividends, again, pays out every 3 months. And on tomorrow night in class, we're going to go, and I'm going to show you some ETFs, exchange traded funds, that pay out every month. So you get a paycheck every month. All right, so that's kind of cool, instead of every 3 months. So we're going to, don't miss class on tomorrow night, because we're going to go to the next step. We're just doing stocks with dividends. Now we'll do ETFs. An ETF, of course, is an exchange traded fund where it has a basket of stocks. So we take all the best stocks, put them into a basket, and then that basket of stocks will give dividends, okay, from all the good stocks. So that's what these ETFs are. So we're going to talk about some of the top ETFs that give dividends. And then we're going to take a week off, and then we're going to come back a week later. That's when we're going to talk about the high yield dividends, and we're going to start reversing our thought, and we're going to start doing things a different way, right? We're going to start thinking about putting a business. Now, it's like I was saying earlier, in the stock market is like a sandbox, and you can build almost any model, any business model you want in the financial markets. Most people only think of growth. All right. So you can do growth, and you can say, okay, that's like the toy store. Now what we're doing is, because we're getting a yield, right? We're getting growth and yield. Now it's like a rental house. So we go and buy a rental property. The rental property goes up and down in value all the time. We just don't look at it like we were talking last night. The reason people don't buy and sell their houses like crazy is because, one, it's hard. It's hard to buy and sell a house. It's not as easy as it is to buy and sell on the stock market. And now we're getting rent. Okay. So if we get we build a model, it's all in your brain. It's how you think about it, how you're going to run it, how you're going to manage it. We've now got ourselves a rental property. So we got buy low, sell high. Now we're talking about buy low, sell high, but we're buying the house, but we're going to rent it to get the yield. All right. So the yield is, now we're building a rental property in the stock market. And what we're going to talk about next, in the next class after this one, which is the second week of February, we're going to talk about building a business in here. And one of those businesses that we're going to talk about is an insurance company. All right. So we're going to set ourselves up an insurance company in the stock market. Now, there's other businesses we're going to talk about as well. There's manufacturing businesses. We're going to talk about how you set up a manufacturing business, but it's going to be how you mentally think about and how you manage your money and how you build your spreadsheets to track it. All right. It's going to be how you manage your business. Are you going to be a buy low, sell high business? Are you going to be a rental property business? Are you going to be a manufacturing business? Are you going to be an insurance company business? How do you think about your business? How are you going to run your business, and how are you going to model in the financial world, in the stock market, which is nothing more than a big sandbox where we can build any type of model that we want? Okay. So right now we're talking about rental properties. That's what this is. This is a rental property. We've got a property. We got a piece of asset, which in this case is Coca-Cola, and it pays us rent. Okay, so it's just like a rental property. It's paying us 50 cents for every share that we have. So for every share you have, now remember last night we were talking about dollars being your workhorses. Now when you come to the stock market, it's dollars, it's actually shares that are your workhorses. All right. How many shares can you accumulate? Because the more shares you can accumulate, the higher the dividend. And you're saying, well, this is a $72 share. It's pretty expensive. Well, there's some that are $400 a share, right? And they still pay a dividend. There's also some that are $20 a share and they pay a dividend, but it's all relative. Okay. It's all relative. Some pay higher, some pay less, and it depends on where you bought your shares at on what your percent return is. Okay. So now we're going to take this. This is 51 cents per share on 72. We could do the math. We could sit there and say, okay, we're going to put $10,000 divided by 72. How many shares do we get? Do the multiplication, 51 cents times the number of shares. That's how much we get every quarter divided by 3. That tells you how much every month. Multiply it by 12. It tells you how much you're going to get by the year, right? Very simple, very easy math. First grade math. Add, subtract, multiply, and divide. So now what we're going to do is we're going to take in and we're going to go over to a software program that does this for you. Okay. We got a software program that does this for you. So I've got a couple of them. I'm going to show you one. The first one that's very simple and easy. This is one. If you go to, it's called the Dividend Calculator right here, and it's Pitt News. That's my company, right? Remember Pitt News Magazine and Pitt News Press. So you go to pitnews.com/dividend calculator. Can you see that? You don't need this part. Get rid of that. It's just pitnews.com/dividend calculator. Go ahead, take your little camera and take a picture of that so you don't lose it. It's not published out on the web. It's just for my people. It's just for you. It's just for you. Okay. I have not put this out on the web. There's no link to it or anywhere. It's hidden. It's hiding just for you. And I have a course that you're going to get when you come to the class next week or in 2 weeks that has all the educational material that goes along with it, not just the slides, but also I've got a whole bunch of articles and videos and everything that ties this all together. And of course, there will be a link to it in there. So you'll have a link to it. But for now, just go to Dividend Calculator. Okay. And we're going to come into Dividend Calculator and we're going to type in here. Let's go in, and what did we say? It was Coca-Cola. So we're going to type in KO is the symbol. And the share price, I'm going to just flip back and forth here for a second. The share price was $73.33. So we're going to put in here 73.33. And the dividend amount, the dividend that it's paying, oh, we got to get that from this little calculator. The dividend that it's paying, oh, not that one, this one, is 51 cents, right? 0.51. So we're going to come over here. Oh, it's right here. 0.51. I've got so many windows. 0.51. I guess that's why they call it Windows, isn't it? And then we know that this one is paid out quarterly, so we put in quarterly, and we're going to invest $10,000. So the same number we did with our little calculator. And you hit calculate, okay? And that's going to give you the little table. So the annual dividend yield is 2.78%. That's about what you get down at Cache Valley Bank. And if you're really just going for the interest rate, you're probably not very wise to put it into Coca-Cola. Why? Because if you're just going for 2.78%, Coca-Cola has a chance of going down and you could lose a whole bunch of growth, right? To get the 2.78%, which you can get down at Cache Valley Bank with no possible loss. Think about it. If you're just going for the dividend. So you want to also make sure that you're also going for some growth. You want your house to grow. It's a rental property. You don't just want to live off the rent. You want to take into consideration the growth of the house, right? We talked about that last night too. So you have the rent that's coming in, and oftentimes the rent just pays enough to pay the upkeep on the house. So then you have to have the growth of the house. Well, this is basically the same concept. You're going to have some growth because the 2.78, it's not very much, right? You could get 2.78 at Cache Valley Bank without any risk. So when we trade dividends, the dividend is not the most important thing. The yield is not the most important thing. The growth is. So we need to concentrate on growth. We need to understand how to buy low, sell high. We need to have those strategies built under our belt. Those of you who are in the first class, you saw me give you that example of a pyramid, the upside down pyramid and the upside right pyramid. Don't ever build an upside down pyramid. right? Especially, it's very important. A lot of people build upside down pyramids because of the dividends. So it becomes a dividend trap where they're like, well, I'm doing it for dividends. So it doesn't matter if I do poorly on my investing on the long term. Oh, yes, it does. It can really screw things up because the amount of money you're going to get on the dividends isn't enough. Okay. So that's why we're going to go into a world. I'm going to take you into the next world where we're going to go the other way, where the yield is the big one and the growth is the small one. Okay. Not that the growth's not important, still is, but the yield is going to become the primary, not the secondary. Because right now, yield is secondary. Excuse me. All right, so let's compare. The neat thing about this little calculator is we can put another one in here. Boy, I'm losing my voice. All right, let's come over here. Hold on a second. That's why I have two waters next to me. I have a cold one and I have a hot one. try and keep my voice going. All right. So what we're going to do now is we're going to come in here and we're going to the next one. And we're going to say, oh, we got to go over to our list. So go over to our list. And these are the popular ones. There's Chevron. Chevron's popular. Look at it. It's taken off, going to the moon. Kimberly-Clark. Oh, it's way down. So maybe we could get a recovery on Kimberly-Clark, right? Buy low, sell high. But now we want to do, if we're going to do Kimberly-Clark, we don't want to just say, well, it's low, I guess I'll go buy it. We want to see if Kimberly-Clark's got some issues. So let's go look at KMB over here. And we're going to come down and we're going to put in KMB. KMB. And we're going to pull up Kimberly-Clark. And they've got earnings coming out year over year. Sounds like they've got some good earnings. Let's come in here. Oh, doesn't like that. Let's fix this. So green, revenue down. That's not good. They have good earnings, but their revenue's down. So let's come down here and look down here. You can see sales. Oh, they had a bad 2023. 2024 came back, but it was equal to 2022. They're buying their shares back. So those of you who are in my other class, you know, we don't like to see that if we're getting into a stock. That means that they are propping their stock up to make their earnings per share higher. So the reason their earnings per share is higher, they did have a little bit of a bump on their money, but they're buying their shares back. So that pushes this number up. And when they buy their shares back, that falsely pushes this money up. So they're not really getting bigger earnings. They're just having fewer shares. All right. So that's not good news, but let's see what their sales are. Sales, 18 billion. So they're on track for 18 billion, 18. So that was probably, since this is still in January, that was probably last year. So it went from 20 billion down to 18 billion again. So that's not good. So if you want to get into Kimberly-Clark, again, you're going to do your math, $101 per share. And then their dividends back here, they're paying $1.26 per share. So let's go see how that compares to Coca-Cola, should we? So we're going to go back over to our calculator. And remember, it's 101 and 126. And it was KMB. So we're going to go KMB. Share price was 101. Is that what I said? 101? No, I forgot. 101.61. So we'll go 101.61. And the dividend was $1.26. 1.26. And then we're going to do this as quarterly again, like quarterly. That's right, quarterly. Okay, $10,000. Now we're going to calculate, and we're going to compare Coca-Cola against Kimberly-Clark. So now when you come down here, calculate and compare. There we go. So now we got Coca-Cola up here, and we got Kimberly-Clark down here. So now we can see the annual dividend for Coca-Cola is 2.78. The annual dividend for Kimberly-Clark is 4.96. How about that? So weekly, you're getting $9. Monthly, you're getting $41. You're getting $5. You're getting $23 on Coca-Cola. Yearly, you're getting $496. versus yearly $278. 5 years, you're getting $2,480, 24% cumulative, $1,300. Or portfolio after 5 years, you've made $12,000 in dividends versus $11,000. So see, the dividends start to add up. So if you're going to trade the stock anyway for growth, right, which is what you're going to do, you're going to go out and you're going to look for good stocks that grow over a period of time. And then if you can get one that's returning a 4 or 5% return after 5 years, $12,000, that's a significant amount of money. $12,000 in 5 years, right? It's better than not having any at all. So if you're going to trade, that's what we oftentimes say. Try and trade in markets that are going to give you dividends. If you're going to do this little buy and hold thing and hang on to your stocks for 5 years, well, an extra 12,000 little bonus, that's pretty nice to have. Not going to live off of it, not with $10,000. But if we put in a little bit more money, what if we put in $1 million? 1, 1, 2, 3, 1, 2, 3. Calculate and compare $1 million in 5 years. You're going to get portfolio value is $248,000. That's a good amount of money, right? With a 5% return. So your portfolio will be $1.248 million. So basically, if your $1 million turned into didn't grow, but you had $248 in dividends every year, $50,000 in dividends, and that's continuous growth. So with investment, without reinvestment, with reinvestment, 1,279. So that's the difference, 27% annualized return. All right, so there you go. So that's how you do your little bit of comparison. And I like to use 10,000 because it's a little bit more easier to wrap your head around and see what you're doing. And then you can kind of go from there, depending on how much money you actually have. All right. So that's a nice little calculator to let you do it. Now I'm going to show you another way that's going to even be better. Okay. We're going to go into a software program called Portfolio Matrix. And we're going to go into Portfolio Matrix and I'm going to show you how to create a portfolio. We're going to come in here. We're going to add a group and we're going to call this our popular dividends. Popular dividends. And we're just going to come in here and we got to put that list in here. And I'm going to look at them one at a time and add them one at a time because we're going to come in here. You can just add them all in here just like we did before. You can go Control V and it's going to put them all in there just like that. But I want to use the other list. So we're going to actually cancel this. And I'm going to come in and I'm going to go My Portfolio, add a group. And we're going to come in and we're going to say Popular Dividends. And we're going to build a portfolio and look at our entire portfolio. This is way cooler than the other little calculator I just showed you. But you have to subscribe to this software program. All right. It's another program you subscribe to. You go to portfoliomatrix.com and you subscribe. And you can do this entire portfolio stuff. And then you can also import your own portfolio and it'll do all this really neat stuff on your portfolio. Shows you what you're doing. Okay. So this is, let's see, we're going to go in here, Popular Dividends. We're going to create the group. And now we're going to come in and look at them one at a time. So I'm going to come in and I'm going to pull up KO because KO's, KO. So we're going to put KO into our portfolio, but I want to look at it and I want to look at it in two separate ways. Now that's what, this is the coolest thing since smoked fish. I didn't want to say sliced bread. All right. Didn't want to say sliced bread. This is the coolest thing since smoked fish. Okay. So we're going to come in here and take a look at this. Now, this is one thing that I have never seen anybody else do this. And what we do in this program is we come in here and we KO market price. So that's the market price. And then you can see the reinvested dividends if you drip it in, if you drip your money back in. Now, remember, drip just means you're going to take the dividends and they're going to give them to you. And then you're just going to put them right back into the stock. You're just going to put them back in, reinvest them. So if you would have reinvested, here's your gain. See how it breaks it apart. And I told you, you got to break these two apart. The gain was 16% over the last year on Coca-Cola. So Coca-Cola rose in price over the last year, 16%, and it gave you a 2.93% yield. So if you add those two together, last year you got 19.29% in Coca-Cola. That's the combined growth plus the yield. All right, gain plus yield, gain plus dividends. Now, some people out there in the world will call that the yield. All right, but it's combined. It's the gain and the yield. So you have the yield, which is the dividend, and then you have the gain, which is 16 0.36%. So that's really cool. So let's add that to our portfolio. Let's go ahead and we're going to add Coca-Cola, popular dividends. We're going to come in here and we're going to go add Coca-Cola. And now we got Coca-Cola in our portfolio. So now we're going to come and we're going to do that with all the rest of them of the popular list. So we're going to come over to track and trade and our popularity. The next one we're going to look at, this is here. This is CVX. Let's come in here and delete all these drawing tools. We're just going to look at this. I don't want that I want bulls and bears. I don't want Bollinger Bands. I want bulls and bears. So we're going to go bulls and bears and we're going to turn that on. And then we're going to chalk and money flow. We're going to turn on MACD and we're going to turn off chalk and money flow. And we're going to come in here and we're going to save and apply settings to all charts. So all our charts look like this now. All right. So Chevron is taking off, going to the moon. And we can come in here and Chevron, we don't have to go over to that little free chart over here anymore. We no longer have to go to this one and sit here and do all the math manually with our little calculators. Why? Well, because we got Portfolio Matrix. And we don't have to go into this little tool and sit here and type all this stuff in. Why? Yeah, because we got Portfolio Matrix. So now all we have to do is come in here and CVX was our symbol, right? From right here, CVX. So we're going to come in here. We're going to type CVX. CVX, and it's going to do all that hard work for us, and it's going to show us a chart. So now we got the gain, which is 7.23%. So that's how much our house, our rental property, has gone up in value, and we received 4.5% in rent last year. So this is last year. And see up here, you can see 1 month, 3 months, 6 month, 1 year, 2 year, 5 year, 10 year, last year, year to date. You got all these little dates up here, and you can go see all this information for any time frame that you want. So we come in here and we say that our yield was 4.57%. Well, that's awesome. It was a high yield. It wasn't that great a growth. There's only 7% growth. So last year we got 11.8%. Now remember our rule of 72. How long would it take us to double our money at 11.8%? Now we did our about 10%, right, with 7 years, a little over 7.5 years was 10%. Well, this is 11.5%, almost 12%. So you would double your money in this one. If you do the rule of 72, it would be a little bit less than 7 years, right? So you can do the math. I'm not going to do the math on each one of these in the interest of time, but you can do the math. We did the math last night. You know what the rules are. You could then create a portfolio out of this or a little spreadsheet and do the 4% rule, right? Or you could raise it, as was mentioned in class. Why are we only doing 4%? Well, because they generally figure that you're only going to be making over a period of time 5%. Okay. Even though the market does 10% on average over 25 years, we're going to be conservative and say that you're going to make 5%. But if you are consistently making more, you're a better trader than just 5%, and you can take more than that. You can just, if you consistently or your portfolio is making 9%, well, take out 8%, right? So it's just an example. It's just a math model, and then everybody's portfolio is going to be different. Yours might be a negative number. I don't know. Hope not. All right, so that's CVX. We're going to add CVX to our portfolio, and you can see what we're going to do here. We're going to now go through and look at a portfolio with all of them combined. That's cool, right? We're going to see everything. Okay, so we got our CVX, Coca-Cola. Now we're going to come in here. The next one is Kimberly-Clark, KMB. Look at that baby. She's rocking and rolling. She's breaking new highs. We already talked about that one. Kimberly-Clark. We're going to go in here. KMB. KMB. So this is our Kimberly-Clark portfolio. We're going to, come on, pull it up. There we go. All right. So Kimberly-Clark had a gain of negative 21. She lost money last year. All right. But she made 4% on their dividend. So she had 17%. So the dividend only covered, didn't cover nearly as much of the gain as you would hope. It covered 4% of the loss. So you're down 17% on that one. So let's add that one to our portfolio. We got to have some losers in here. And then hopefully she'll turn around, right? She's turning around. She's coming up, breaking new highs. So maybe we'll do better this year. So the next one is Lindahl, LYB. Oh, the data didn't load on that one, but we're going to take it anyway. We'll see it over here. LYB. LYB. And we'll pull that one up. And the gain on that one was, down 35% last year. But it had a high dividend, right? 9%. So we sacrificed 35% to get 9%. Hopefully you're doing better than than that to buy some stocks that are rising. We buy low. Hopefully we didn't buy back here at the top and ride it all the way to the bottom. Well, I'm going to ride it all the way to the bottom. Why? Well, it's giving me 9% return. Yeah, but that didn't cover it. So now you're down 25%. So we're gonna learn this too. I mean, this is part of another class where we're gonna go through and we're gonna learn again how to roll our money in and out of these different markets based on these mathematical models. And this little program here is going to help us with that too. So we're going to add LYB to our portfolio. So that's what happened. Oh, we have that one in our portfolio. Land, don't put that one in. No, we got to put it in. It's from our list. All right. MO, Altera. That's another one. Taking off, going to the moon right now. It's been down in here, right? Look at that. Red to yellow to green right there. There's your little buy signal. The accumulation zone. Look at that. Beautiful little zones in here. Little zones of accumulation. There's red, yellow to green. That's what you're looking for with this indicator. All right. And plus some other things. It's not just that all by itself. You never want to use any indicator isolated in by itself. There's other things we want to look at. All right. So we're going to go look at MO, Altera. We'll add that in. Come on, baby. Pull her up there. Okay, so we had last year, we had a gain of 19%. Oh, nice. And then a yield of 7%. Ooh, nice. That gave us 26%. That was a good buy. Let's go look at that chart again. That was down in here last year, and now it's way up here. We did have some struggles in there. We were like crying the blues for a little while, weren't we? All right, but it all came out in the wash. So now we got 26%. We're going to add that one to our portfolio. We're going to go over to the next one is Merck. Oh, look at Merck. It's on fire. MRK. So we're going to go put Merck in our portfolio. MRK. MRK. We'll talk about standard deviation, max range, yield deviation, max yield range, payout frequency. We know what frequency is. It's quarterly. So we'll talk about those other things. That's just mostly how far the market has a tendency to move within a window. That's what that means. All right, standard deviation. So our most important number for us is the gain and the yield. So this one had a gain of 10%. So last year, Merck went up 10%, and it gave a dividend of 3.7% for a 13.91% return. Almost 14% return. We're going to get our money. We're going to double our money if we could maintain that in less than 7 years, right? Less than 7 years. We could do the math, but you know that 10% is 7 years. So 13.9 is less than 10 years. Or 7 years, less than 7 years. Okay, so let's add Merck to our portfolio. Now we're going to come back over and we're going to do Realty. Ooh, beautiful. Nice big uptrend. You going to buy it right now? Buy high and sell higher? Is that how you're going to trade? Okay, do what you want. Okay, we're going to put O in here. Oh, that didn't go. Oh, there it is. All right, so now that did 9% return with a 5.63% annual dividend yield. Wow, for a 15% return. That's pretty awesome. So let's come and add that to our portfolio. Now we're going to come over here and we're going to go to Pepsi. Look at Pepsi. It's doing pretty good. It was clear back here. That's pretty good. Let's go see what Pepsi's doing. PEP. Last year, Pep had a gain of, drum roll please. Come on. 2.92%. Oh, it lost 2%. Oh, it lost 3%. And it had a 3.92% yield. So it made a 1.1%. So it was kind of a scratch trade. We're going to add that to our portfolio. And we're going to come down here to PFE so that you can all get a nice new Corona shot. Are y'all getting your Corona shots so that your PFE is going up in value? Okay, let's go over to PFE. Look at that big Paparoony. PFE. Pfizer. Gain down 3%. Oh, but they had a yield of 7%. Holy smokes, for a 3.85% return. All right, let's add that to our portfolio. Now we're going to come down here, USO, United States Oil Fund. Oil, USO. Let's see what their dividends are. USO. That's a fund. Look at that. They're gonna, oh, they don't give a yield. How come is that even in our list? We're not going to add that one to our portfolio. Bye. See ya. Wouldn't want to be ya. Okay. We go down here to Verizon. Verizon, VZ. All right, let's go to VZ. Verizon. And Verizon, the gain was a negative 192, and the yield was 6.65%. That's pretty cool. So we get a gain and a yield of 4.72. Let's add that to our portfolio. Now that we got a portfolio, we can go in and look at our portfolio. Now it's not got any money in it. So, of course, it's going to come up and say nothing because this is for real money trading. So if this was your portfolio, it would show you what you had. You can connect it to your brokerage account and it'd bring in all your money. Since we don't have anything, what we're going to do is we're going to go to a targeter. We're going to take it from our popular dividends. We're going to go over to our targeter. And now what we're going to do is we're going to say, if I put $10,000 into this portfolio, how should I put it to make the maximum profit potential? So we're going to come in here. We're going to do relative performance. We got all these little math formulas: relative performance, equal outcome, and equal diversification. We're going to say relative performance, and we're going to come in here. We're going to do price gain, dividend yield, combined gain plus yield. That's probably the one when we're doing general stocks that we want to do. Okay, so we're going to do gain plus yield, and we're going to come in here, and we're not going to leave a max ratio. We're just going to apply and view. And out of our $10,000, it says, well, if you're going to put $10,000 into this portfolio to maximize your profit potential based on history, past performance not necessarily indicative of future results, but it's best we got, right? So we're going to come in, we're going to say on MO, we're going to put 26% of our portfolio based on gain and yield. And we're going to put $2,762 in there. And we're going to annually receive $194, and we're going to monthly receive $16 in yield. Okay, so we're going to come in here, and we're going to say Coca-Cola gain plus yield is 19%. And so we're going to put $1,993 of our $10,000 portfolio in here. And then this one, we're going to put in 15.49, or the equity is $1,600 out of our 10,000. And then we're going to put 13% into Merck, 11 into CVX, 4.72 into Verizon, 3.85 into Pfizer, 101 Pfizer, 1786 into Kimberly, and our negative, we're not going to put anything in there. So you see our dollar amounts, we're not going to put anything into LYB. The gain plus yield is negative, so we don't put any money in them. Okay. Now you can reverse that and say, well, I want to do it the other way around. I want to invert the ratios because I want to buy low and sell high. Now what we would be doing is we'd be putting most of our money into the low ones. So we're going to be putting all of our money, $2,000, $2,700 into the ones that lost money last year, if you want to do it that way. See, and we'd put the least amount of money in the ones that are flying high and the most amount of the money in the ones that are down. And it would tell you the percentages and how you should do that to maximize your profit potential. And then it's going to come over here and tell you your gain. On the first one we did, you can see we got the two different reports in here. Is going to be 12%. On the annualized yield is 5%, and you're going to have a gain plus yield of 17%. And then if we do it in the inverse, based on past performance, it would have been a negative 14% on the yield. Annualized dividend would have 6%, so you'd have lost 8% if you'd have done that last year based on today's numbers. But going forward, nobody knows what the market's going to do in the future. And are you going to buy low, sell high? And so you can invert and put the ones that you want to buy in here. And that's what I like to do. I like to come in and put the ones that I'm going to buy into my little popular dividends, or I like to call it just I create a little portfolio over here of things I want to buy. And the reason I want to buy them, and I've gone through and I've done my analysis and I've done my mathematical modeling, my delta Kona probability, and I look where things are and I'm like, okay, I want to be in that stock and I want to take advantage of it because I think it's going to rise in value. Plus it's got a dividend, right? So then I'll build a portfolio and then I'll have the software tell me how much money to put into that portfolio. And if I want to invert it, I can. If I only want to have it based on yield instead of price, I can have it just on price, or I can have it based on dividend alone. So we can come in here and calculate just based on which ones are giving the best dividends, and it'll give us a distribution of our $10,000 into the portfolio of the ones that we want just for that distribution. And what if you don't want to have one? Well, I don't want to have any in PEP. You can come over here and you can just delete it or remove it or exclude it from the calculation. See that? So you just exclude it from the calculation, and then it won't put that one into your list. So you can have your list and say, well, I only want to have these 5 or out of my 10 are the ones I want to put money in out of my money that I've got to be invested today. And you can just tell it what to do, and it'll tell you how to put your money in. Okay. And that's really cool. That's the way you do it. And then there's one more step. Like now that I've got my portfolio, next month I might have some money that I want to put in. I have another $1,000 that I got from work and I want to put that in. I can come into the rebalancer, and based on the information that we just put in, it'll tell you right here automatically, based on what we did on our previous targeter, it'll just say, hey, to run this same strategy, you just come to the rebalancer and it'll go and it'll tell you exactly where to put your money. pretty darn cool. All right. And then, of course, once you do have money in all these portfolios, you come out to your group performance, and then it's going to have all the statistics for you. Comes down here. It's got a beautiful little calendar that shows you all of your money in here and how much money you're making on each one of these individually, how much it's growing, how much your dividends are, how much money you're making each quarter. So your dividend calendar is all down here. So it's got everything all tied in here for you, and it shows you on a portfolio basis what your gain is, what your yield is, and how you can track that whole thing. And I don't know how you can make money without something like this to do it. You can do it yourself in a spreadsheet, and I'm going to pull up real quick my spreadsheet because I have a spreadsheet too. We want to keep them in a spreadsheet, but I also have this little software program going, but here's the spreadsheet. So you can see my spreadsheet, and you can see I ended the year at 62%. I'm currently at 56%. So it's gone down since I ended the year at 62%. But you can see my spreadsheet in here, and you can see all my dividends and how much money I made. $17,000 that month, $37,000 that month, $24,000 that month, and $56,000 that month. Okay. So on the quarterlies, that's how much money I made last year. And now I've got this year coming along, and it's all just calculated in this little spreadsheet. But this only shows this little spreadsheet I do for our classes, so you can see how I'm tracking it. So you can, and then I give you this spreadsheet for free. You can have this spreadsheet, so you can just take it and put your stuff in here if you want. And then you can do it all manually for free. That's why I give you this, because I like people to be able to have free. So I maintain my spreadsheet. And then if you subscribe to Pit News Magazine every month, when you get your email that tells you the new version of Pit News Magazine is available, it has a link to this updated spreadsheet. Anytime I make changes to it or update it. And for those of you who have Pit News Magazine, this month, the February issue is going to have an update to this because I found some errors in it. Right? Like it's a model we're a working model. And so I'm changing things and making changes, and I found something I didn't like. So I took it out and I redid it. And so you're going to get this spreadsheet when you have Pit News Magazine. All right. Lan, I want Pit News Magazine. How do I get Pit News Magazine? Just go to pitnews.com and sign up. All right, guys, that's what I got for you. And if you have any questions, please let me know. And we're going to see you guys again tomorrow night at 6 o'clock, same bat channel, same bat cave. And we're going to go through and we're going to take you to the next step. All right. So we build our portfolio with single individual stocks that pay dividends. Tomorrow, we're going to start talking about ETFs, exchange traded stocks, where people, firms have already taken these individual stocks and created baskets of stocks, and they pay dividends. And we're going to talk about some of the top best ETFs. All right, ETF, dividend paying ETFs. And we're going to do the same thing. We'll build portfolios. We'll talk about them. We'll talk about when to buy them, when to sell them, how to roll our money in and out. And depending on how old you are, what your ages are, it's going to make a difference on how you invest. Okay. How much time do you have out there? All right, guys, that's it. That's all I got for you today. If you have questions, let me know. You got my email address. You got most of you have my cell phone number, so you can call me if you need to. But the best thing to do is to go to my, go over to Lan Turner, Lan Turner. You can just go to lanturner.com. Just go to my website. It's the easiest place, and click that little button right there. It's called Contact Me, and that'll pull you into my account right here. And then you can choose which one of these services you want to talk to me. And if you're at the university, of course, we got the Utah Tech University right there, and I'll talk to you in person. We can talk to you about your goals and aspirations, help you set up your ideas and see what you want to go and what you're doing and what questions you have and where you're at in your trading. I want to help you. And for the students at the university, because you've already paid your tuition, this is free. It's a free service for you to call me and talk to me one-on-one. all right, privately. You can also stay after class. I don't mind staying after class, and I can talk to you one-on-one in person after class about some of your questions as well. But this is a great way to do it. You put your phone number in there, and then at the time, you pick a time. If there's a time available, that's when I'm available. So don't worry about when's Lan available. It's when you're available. You go in there, you can see when I'm available, and then you put your phone number in there, and I'll call you on the telephone. So it's not a person in one-on-one personal meetup. It's we talk on the telephone. All right. And then these are the rest of the services that are in here. If you guys are interested in any of these, you can do these as well. All right. And that's it. Okay, guys, we will catch you tomorrow evening. And are we going to have class tomorrow here? Are we going to have another lab tomorrow? We're going to have a lab tomorrow afternoon at 1 o'clock for those of you who have taken the day trading class. So we have a day trading lab at 1 o'clock tomorrow afternoon. If any of you want to join, it's fun. You can come and watch us do a little bit of day trading tomorrow afternoon. You can see how that's done. We show you the settings, the software that we use, and all that kind of fun stuff. And we practice doing our day trading. Okay? So we'll see you guys tomorrow afternoon or tomorrow evening, whichever comes first for you.
All right, that wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pitt News Magazine.
Oh yeah, definitely subscribe to Pitt News Magazine. You'll thank us later.